macro currency signals.
Stackers, investors, patriots of hard money, we are not here to speculate. We are here to prepare. For 5,000 years, through empire collapses, currency failures, wars, and banking crises, two assets have survived every reset: gold and silver. When Rome debased its currency, silver told the truth. When Weimar printed into oblivion, gold preserved wealth. When modern banking trembles, capital runs back to metal. Silver is not just a commodity. It is money with industrial demand. It is monetary insurance with explosive upside. And right now, the system holding it down is showing fractures. There are moments in history when the noise fades and the truth becomes unmistakable. We are living in one of those moments. Across the globe, confidence in currencies is quietly eroding. Debt levels are no longer cyclical. They are structural. Governments are no longer balancing budgets. They are managing perceptions. And in the middle of all this stands something ancient, silent, and unyielding: gold and silver. These are not relics of a bygone era. They are the foundation that every monetary system has eventually returned to when trust collapses. This is why silver and gold matter more now than at any point in modern financial history. For over 5,000 years, civilizations have risen and fallen, but gold and silver have remained constants. Empires have debased their coinage. Kings have clipped their currency. Central banks have printed their way into temporary prosperity. Yet through every collapse, from the Roman denarius to the paper catastrophes of the 20th century, precious metals preserved purchasing power when paper promises failed. This is not ideology. It is historical record. When trust in institutions weakens, capital seeks neutrality. Gold and silver are politically neutral. They do not depend on policy committees, quarterly earnings, or digital ledgers. They simply exist, scarce, tangible, and universally recognized. Before we go any further, if this breakdown is resonating, make sure you're subscribed and notifications are on. Staying early matters in moments like this. Drop a comment below and tell me where you're tuning in from and what time it is on your side of the world. This conversation is global, and it's always powerful to see how wide the reach really is. What makes this moment different is the scale. Never before has the global financial system been so interconnected, so leveraged, and so dependent on perpetual expansion. Debt must grow to prevent contraction. Liquidity must increase to prevent default cascades. Interest rates must be managed to prevent insolvency. The system cannot afford honesty because honesty would require austerity, and austerity is politically impossible. So the expansion continues. But expansion has consequences. Every new unit of currency created dilutes the value of existing units. It may not be visible day to day, but over time, purchasing power erodes. Inflation is not an accident. It is a feature of debt-based monetary systems. Gold and silver operate outside that mechanism. They cannot be printed. They cannot be digitally conjured into existence. Mining them requires capital, labor, time, and energy. That friction is precisely what gives them integrity. In a world where money is created with keystrokes, assets with natural scarcity become anchors. They represent stored labor and stored energy. They represent something that cannot be fabricated by decree. When people begin to sense instability, whether through banking tremors, currency devaluation, or geopolitical fracture, they instinctively migrate toward tangible value. That instinct has repeated across centuries. Silver carries a unique dual role in this equation. It is monetary, but it is also industrial. It sits at the intersection of finance and infrastructure. While gold primarily reflects monetary confidence, silver reflects both monetary stress and industrial demand. That combination makes it particularly sensitive to systemic shifts. When monetary instability rises and industrial demand accelerates simultaneously, silver does not move gradually, it moves explosively. Historically, during precious metal bull cycles, silver outpaces gold dramatically once momentum builds. It behaves like compressed energy released after long suppression. We must also understand psychology. Modern investors have been conditioned to believe that stability is permanent. Markets recover, central banks intervene, liquidity returns. But what happens when intervention itself becomes the source of instability? What happens when currency creation undermines confidence rather than restoring it? Gold and silver begin to transition from alternative assets to monetary insurance. And once that shift enters mainstream awareness, repricing accelerates. The window between skepticism and urgency can close quickly. This is why gold and silver matter today. Not because of fear, but because of arithmetic. Not because of conspiracy, but because of structural imbalance. Debt expansion cannot continue infinitely without consequence. Currency dilution cannot occur indefinitely without repricing real assets. At some point, confidence meets reality, and when it does, capital seeks refuge in what cannot be debased. Gold and silver are not trades. They are positions. They are not about short-term volatility. They are about long-term preservation of purchasing power. In times of systemic stress, they transform from optional allocations into strategic necessities. The world is entering a phase where monetary discipline is scarce and fiscal expansion is normalized. In such an environment, the importance of hard assets increases exponentially. This is not about panic. It is about preparation. Throughout history, those who understood monetary cycles positioned themselves before the crowd recognized the shift. They did not wait for headlines to confirm the crisis. They studied the structure, they read the signals, they acted early. Today, the signals are flashing again, and that is why silver and gold matter more than ever. For decades, the price of silver has not been determined purely by the forces of physical supply and demand. Instead, it has been shaped, some would say distorted, by the immense weight of paper trading. To understand why this matters, you must first understand where price discovery actually happens. It does not happen at your local coin shop. It does not happen in a refinery. It happens on futures exchanges, primarily through leveraged contracts traded in enormous volume. On platforms like the COMEX division of the Chicago Mercantile Exchange, silver is bought and sold in quantities that exceed annual global mine production many times over. That is the first red flag. These contracts are not necessarily backed by immediate physical metal. They are promises, agreements to deliver at some future date. Most of them are never settled in physical silver. They are rolled over, netted out, or closed before delivery. In other words, the vast majority of silver trading is synthetic. It is paper exposure, not metal changing hands. This creates a structural imbalance between the amount of silver that exists in financial form and the amount that exists in vaults and in the ground. When price is discovered in a market dominated by leveraged paper rather than scarce physical supply, distortions become inevitable. Leverage magnifies this effect. A trader can control large amounts of silver with a relatively small amount of capital. That leverage allows significant downward pressure to be applied quickly during periods of thin liquidity. Large concentrated positions can push price lower through sheer volume, triggering stop losses and algorithmic selling. The result is cascading declines that appear organic, but are often amplified by financial engineering rather than changes in physical fundamentals. Meanwhile, the physical market, where real bars and coins are exchanged, often tells a different story through rising premiums and tightening availability. This divergence between paper price and physical reality is one of the most critical warning signs stackers must monitor. When futures prices drop sharply, but retail premiums rise, it suggests stress beneath the surface. It suggests that the paper market is suppressing the quoted price while real-world demand remains firm or even increases. Over time, this tension builds. Paper markets can create temporary supply through contracts, but they cannot manufacture physical metal indefinitely. Eventually, if enough participants demand delivery rather than cash settlement, the imbalance becomes exposed. History has shown that commodity markets can remain distorted longer than most expect. However, distortions are not permanent. They rely on confidence and liquidity. If confidence in counterparties weakens, if participants begin to question whether delivery can be met, the behavior changes. Instead of rolling contracts forward, holders may stand for delivery. Instead of accepting cash settlement, they may demand metal. That is when the pressure point forms, because when too many claims chase too little supply, price must adjust upward to ration demand. Another layer of suppression comes from perception management. Silver is a monetary metal. Rising silver prices often signal currency weakness. In a system dependent on fiat confidence, rapidly increasing precious metal prices can undermine that confidence. Whether intentional or structural, the result is similar. Volatility spikes are often capped, rallies are frequently sold, and momentum is dampened. Over time, this creates frustration among investors and discourages participation, but suppression does not eliminate value, it compresses it. Think of silver's price like a spring held under tension. The longer it is compressed, the greater the potential energy stored within it. Artificial constraints in the paper market can delay price discovery, but they cannot erase underlying fundamentals. Industrial demand continues, monetary expansion continues, supply constraints continue. Each of these factors adds pressure to the system. The paper mechanism can absorb shocks temporarily, but it cannot override physical scarcity indefinitely. The critical question is not whether suppression exists in some form, it is whether it can continue under increasing systemic stress. If financial instability grows, if trust in counterparties diminishes, if global demand for physical metal accelerates, the paper structure becomes fragile. When leverage unwinds, it unwinds quickly. And when synthetic supply evaporates, the repricing can be abrupt and disorderly. This is why understanding the hidden forces behind silver's pricing is essential. Without that awareness, price declines appear to signal weakness. With that awareness, they may represent pressure building beneath the surface. The disconnect between paper and physical markets is not just a curiosity, it is the fault line that could define the next major move. And when that fault line shifts, the revaluation will not be subtle. Silver is not merely a monetary relic sitting in vaults and safes. It is a living, breathing industrial necessity woven into the infrastructure of the modern world. This is where the narrative shifts from theory to physics. Because while paper markets can create synthetic supply, industrial demand operates in the real economy. It consumes real metal. And once silver is used in industrial applications, much of it is not economically recoverable. It is dispersed, embedded, and effectively removed from above-ground supply. That dynamic alone makes silver fundamentally different from gold. Consider the global push toward electrification. Solar energy infrastructure depends heavily on silver for its unmatched electrical conductivity. Every photovoltaic cell requires it. As governments and corporations accelerate renewable energy deployment, solar installations expand year after year. Each new panel represents incremental silver demand. Multiply that by millions of installations worldwide, and you begin to see the scale. This is not speculative demand driven by investor sentiment. It is structural demand driven by energy policy and technological transition. Now layer in electric vehicles. Modern EV systems require significantly more silver than traditional combustion vehicles due to advanced electronics, battery management systems, and power control units. As the automotive sector pivots toward electrification, silver consumption follows. Add to this the explosion of data centers, 5G networks, medical technologies, and defense applications, all of which rely on silver's conductivity and antimicrobial properties. The metal is embedded in the digital backbone of the global economy. Unlike many commodities, silver often has no efficient substitute without sacrificing performance. While demand accelerates, supply tells a different story. The majority of silver production does not come from primary silver mines. It is extracted as a byproduct of mining for other metals such as copper, lead, and zinc. That means silver supply is indirectly dependent on the economics of those base metals. If copper production slows due to economic contraction or regulatory hurdles, silver output may decline even if silver prices rise. This structural dependency limits the market's ability to respond quickly to increased demand. Ore grades are another critical factor. Over decades, the richest deposits have already been mined. What remains often requires more capital, more energy, and more complex extraction methods. Lower ore grades mean higher production costs and tighter margins. Environmental regulations and permitting timelines further delay new projects. It can take a decade or more to bring a significant mining operation online. In other words, supply is slow, capital intensive, and constrained by geology and regulation. It cannot pivot rapidly in response to price signals. Above-ground inventories add another layer of complexity. Unlike gold, which is largely hoarded and recycled, silver has been consumed in industrial processes for generations. A substantial portion of historical silver production is effectively gone, scattered in landfills or embedded in products too small to recover economically. This means the available stockpile relative to demand is smaller than many assume. When industrial consumption outpaces mine supply, the deficit must be filled from existing inventories. Over time, those inventories shrink. When you combine accelerating industrial demand with constrained supply, the imbalance becomes mathematical. Markets can ignore arithmetic temporarily, but they cannot escape it. If annual demand consistently exceeds annual production, inventories decline. As inventories decline, price pressure builds. At first, the move may be gradual, then it becomes nonlinear. Because once participants recognize tightening availability, hoarding behavior can emerge. Industrial users may increase stockpiles to secure supply. Investors may step in anticipating shortages. The competition for remaining metal intensifies. This is the inflection point where silver's dual identity becomes powerful. It is not just industrial demand pushing price, it is industrial demand colliding with monetary demand. If macroeconomic instability drives investors toward tangible assets at the same time that industry requires increasing supply, the squeeze amplifies. Unlike commodities with elastic supply, silver cannot simply be ramped up overnight. The mining pipeline is rigid, the resource base is finite. The result is a market vulnerable to sharp repricing. Not because of hype, not because of speculation, but because supply chains obey physical laws. You cannot print silver, you must extract it, refine it, deliver it. And when global demand outpaces that process, the only mechanism left to balance the equation is price. Central banks do not operate in headlines. They operate in balance sheets. And if you want to understand where the global monetary system is headed, you do not listen to speeches. You study expansion. Over the past 2 decades, and especially since the last major financial crisis, central bank balance sheets have grown to levels once considered unimaginable. Institutions like the Federal Reserve and the People's Bank of China have injected trillions into the system through bond purchases, liquidity facilities, and credit backstops. This was framed as stabilization. But stabilization through expansion carries long-term consequences. Every unit of currency created represents a claim on real goods and services. When currency supply expands faster than productive output, purchasing power erodes. It may not collapse overnight. It may decline gradually through inflation, asset bubbles, and distorted capital allocation. But the direction is clear. Monetary expansion transfers value from savers to debtors. It rewards leverage and penalizes prudence. And over time, it weakens trust in fiat systems that rely entirely on confidence. Debt levels compound this vulnerability. Sovereign debt across developed economies has reached historic highs relative to GDP. Servicing that debt becomes increasingly difficult as interest rates rise. Yet lowering rates to ease debt burdens risks further currency debasement. This is the trap. Central banks must choose between inflationary policy and financial instability. Tighten too aggressively, and markets fracture. Ease too aggressively, and currencies weaken. Either path introduces volatility, and volatility erodes confidence. Confidence is the true reserve currency of the world. When citizens trust their institutions, fiat systems function smoothly. But when inflation outpaces wages, when asset bubbles inflate beyond reach, when banking tremors emerge, that trust begins to crack. We have seen glimpses of this in recent years: regional banking stress, emergency liquidity measures, coordinated interventions. Each event is treated as isolated, but collectively, they reveal structural fragility. Now observe what central banks are doing quietly. They are accumulating gold. Record levels of gold purchases have been reported by monetary authorities seeking diversification away from dollar-denominated assets. Gold carries no counterparty risk. It is not someone else's liability. It does not depend on another nation's fiscal discipline. When central banks increase gold reserves while publicly defending fiat stability, it sends a subtle but powerful signal. They are hedging their own system. Silver historically shadows gold in monetary cycles. While central banks primarily hold gold, silver has long functioned as complementary money for broader populations. During periods of currency stress, gold often moves first as institutional capital seeks safety. Silver follows, frequently with greater percentage gains, once retail and industrial participants respond. The gold-to-silver ratio compresses during monetary upheaval, reflecting silver's dual role as both monetary metal and industrial asset. Systemic risk today is not confined to one nation. It is global and interconnected. Currency swaps, derivative exposure, sovereign bond interdependence, these linkages mean stress, can transmit rapidly across borders. A liquidity event in one region can cascade into another. Central banks can coordinate interventions, but coordination does not eliminate underlying imbalances. It merely delays their resolution. The modern financial system is built on leverage layered upon leverage. Derivatives magnify exposure. Shadow banking amplifies opacity. When stability prevails, this architecture generates growth. But when stress enters the system, leverage accelerates decline. In such environments, tangible assets with no counterparty exposure become anchors. Gold and silver are outside the web of promises. They require no bailout. They carry no default risk. The critical point is this: systemic risk is rising not because of a single crisis, but because of cumulative policy decisions spanning decades. Expansion without restraint, debt without repayment, liquidity without structural reform. These choices narrow the path forward, and when the margin for error shrinks, markets become more sensitive to shocks. In that environment, precious metals are not speculative plays. They are strategic hedges. If confidence wavers, capital rotates. If inflation accelerates, purchasing power seeks preservation. If sovereign debt markets falter, alternatives gain relevance. Silver, positioned beneath gold in market size yet amplified in volatility, stands at the edge of that potential shift. Central banks may not announce a reset, they may not admit structural fragility, but their actions, balance sheet growth, gold accumulation, emergency liquidity measures, tell a story. And that story suggests the global monetary system is under increasing strain. When strain meets scarcity, repricing follows. A 7,000% revaluation sounds outrageous at first glance. It sounds like the language of speculation, not analysis. But step back for a moment and remove emotion from the equation. Revaluation is not about hype. It is about reset. And resets happen when a pricing structure no longer reflects underlying reality. Throughout monetary history, when distortions accumulate long enough, the adjustment phase is not incremental. It is discontinuous. To understand the case for an extreme silver revaluation, you must examine ratios, currency expansion, and structural imbalances together, not in isolation. Start with monetary expansion. Over the past several decades, the global money supply has expanded at an exponential rate. Trillions have been created to sustain debt markets, stabilize financial systems, and stimulate growth. That expansion has dramatically increased the number of currency units in circulation. Yet silver's above-ground physical supply has not grown at anything close to that pace. When more currency units chase a relatively fixed pool of tangible assets, arithmetic eventually demands repricing. Now consider the gold-to-silver ratio. Historically, for centuries, silver traded at ratios far lower than what we see in modern markets. In ancient monetary systems, the ratio often hovered around 12.1 to 15.1, reflecting relative scarcity in the Earth's crust and monetary use. In more recent history, during precious metal bull cycles, that ratio has compressed dramatically from elevated levels back toward historical norms. Today, the ratio remains stretched compared to long-term averages. If gold were to reprice significantly due to currency debasement, and if the ratio were to compress simultaneously, silver's percentage move would be amplified. This is where compounding dynamics emerge. Imagine a scenario where gold revalues to reflect global debt expansion, whether gradually or through a crisis-driven repricing. If gold doubles, triples, or moves substantially higher in response to monetary stress, silver does not merely follow proportionally. During previous bull markets, silver has outpaced gold multiple times over once momentum ignites. The smaller market size of silver means less capital is required to move price dramatically. It is a thinner market with higher volatility. That volatility cuts both ways, but during monetary resets, it tends to favor upside acceleration. Add to this the structural deficit in physical supply. If industrial demand continues exceeding mine production, inventories decline. If investors simultaneously increase physical accumulation, available float tightens further. In a stress scenario, where paper market participants seek delivery rather than settlement, the leverage embedded in futures contracts becomes exposed. Too many claims against too little metal creates a short squeeze dynamic. When leverage structures unwind, price discovery becomes violent. The adjustment is not polite, it gaps. 7,000% is not a forecast with a calendar date. It represents a theoretical revaluation if multiple pressure points resolve simultaneously: significant gold repricing, ratio compression, paper leverage collapse, and physical scarcity recognition. When systems reset, they often overshoot equilibrium before stabilizing. Fear and urgency replace complacency. Markets that were suppressed for decades can reprice in compressed timeframes. It is important to understand that revaluation does not require hyperinflation. It does not require total collapse. It requires recognition. Recognition that fiat purchasing power has declined more than reflected. Recognition that tangible assets are undervalued relative to currency supply. Recognition that synthetic supply cannot indefinitely suppress physical scarcity. Once that recognition reaches institutional scale, capital flows shift rapidly. The most powerful price moves in history have occurred when narratives flipped suddenly, when housing could never fall until it did, when tech valuations were permanently elevated until they weren't. In precious metals, the prevailing narrative has long been that silver is abundant, outdated, and secondary to digital finance. But narratives change when stress exposes structural weakness. If even a fraction of global capital reallocates toward tangible monetary assets during a systemic event, the silver market's relatively small size becomes a multiplier. It cannot absorb massive inflows without dramatic repricing. That is simple liquidity mathematics. So when we speak of a 7,000% revaluation, we are not invoking fantasy. We are outlining a convergent scenario: monetary expansion, ratio normalization, leverage unwinding, and supply deficit collision. Rare? Yes. Impossible? No. History does not move in straight lines. It moves in cycles, and when cycles turn, they do not ask for permission. If the thesis is even partially correct, if systemic stress rises, if monetary expansion continues, if silver faces both industrial strain and monetary demand, then the question is no longer theoretical. It becomes personal. What does this mean for the stacker? What does this mean for the individual who understands that wealth preservation is not about speculation, but about positioning ahead of structural change? First, this is about ownership, not exposure, not derivatives, not paper proxies. Ownership, physical metal in your possession or in secure allocated storage, removes counterparty risk. In times of stability, counterparty risk feels abstract. In times of stress, it becomes painfully real. Financial crises reveal how quickly promises can be suspended, settlements delayed, withdrawals limited. Physical silver and gold exist outside that web of obligations. They are not someone else's liability. That distinction matters most when confidence is strained. Second, allocation discipline is critical. Preparation is not panic buying, it is consistent accumulation over time. Stackers who approach precious metals with strategy rather than emotion build resilience. Dollar cost averaging during volatility reduces psychological pressure. Recognizing that price suppression, if it exists, creates opportunity rather than discouragement, reframes downturns as accumulation phases. The goal is not to chase spikes. The goal is to build a foundation before spikes occur. Storage strategy also becomes part of the equation. Diversification is not only about asset classes, it is about location and access. Some prefer private vaulting with audited allocation. Others prioritize personal custody. The key principle is clarity. Know where your metal is, how it is held, and under what legal structure. In a liquidity event, ambiguity becomes vulnerability. Simplicity often equals strength. Liquidity planning is another overlooked component. Precious metals preserve purchasing power, but converting them efficiently during crisis conditions requires foresight. Establish relationships with reputable dealers, understand bid-ask spreads, monitor premium dynamics. In a tightening physical market, premiums can expand significantly. Stackers who understand this landscape are better positioned to act decisively rather than react emotionally. There is also the psychological dimension. When volatility increases, narratives shift quickly. Media coverage often lags reality. By the time mainstream outlets highlight shortages or rapid price increases, much of the move may have already occurred. Preparation requires acting before consensus forms. That is uncomfortable. It means accumulating when sentiment is skeptical. It means holding through periods of stagnation. Discipline separates participants from observers. Risk management remains essential. Silver is volatile. It can experience sharp corrections even within long-term bull cycles. Overexposure without diversification introduces unnecessary stress. Precious metals are a hedge against systemic instability, not a substitute for comprehensive financial planning. Balance strengthens conviction. When allocation is appropriate, temporary price swings become manageable rather than destabilizing. Another crucial factor is time horizon. Monetary cycles unfold over years, sometimes decades. Patience is not passive, it is strategic. The stacker mindset rejects short-term noise in favor of structural trends. If systemic imbalances continue building, if currency dilution persists, if industrial demand accelerates, the long-term thesis strengthens, regardless of interim fluctuations. Finally, urgency does not mean panic. It means awareness. It means recognizing signals, tightening supply chains, expanding central bank gold reserves, rising debt burdens, increased market volatility. When these signals converge, reaction time compresses. The window between early positioning and widespread recognition narrows rapidly. Those who prepared gradually find themselves calm amid turbulence. Those who delayed scramble for access. This is not about predicting the exact moment of repricing. It is about acknowledging that structural fragility exists and acting accordingly. Every generation faces its own monetary turning point. The individuals who navigate it successfully are rarely the loudest voices. They are the most prepared. For the stacker, the strategy is clear. Accumulate with discipline, store with intention, plan with foresight, and remain patient. If revaluation unfolds, whether gradually or explosively, it will reward those who treated silver and gold not as trades, but as insurance against uncertainty. Preparation transforms volatility from threat into opportunity. And when the system shifts, preparation becomes power. A 7,000% silver revaluation is not a prediction. It is a scenario built on structural imbalance, paper versus physical, debt versus discipline, suppression versus scarcity. Silver is both industrial lifeblood and monetary insurance. And when those two forces collide under systemic strain, the repricing could be historic. Stack wisely. Think long-term. Understand the system. Because when the reset comes, it will not wait for permission. And those holding real metal will not need explanations. They will already understand.